Happy December, everyone! This is Team Bini, and we are gonna discuss indicators and oscillators. Let's start. So, what is technical analysis? Technical analysis is a method of evaluating financial market by analyzing historical price and volume data to predict future price movement. It focuses on identifying trends, patterns, and key levels using charts and technical indicators. Now, think of it like predicting the weather, but for stocks. Just like you can guess tomorrow's weather by looking at clouds and wind, technical analysis helps us guess if a stock's price will go up or down by looking at patterns and numbers. Stocks are like toys at a store. Their prices go up and down depending on how much people want them. So, what are the importance of technical analysis? We run it down to four. Technical analysis helps us identify trends, helps traders recognize market direction, whether upward, downward, or sideways. It time our decisions. It assists in determining optimal entry and exit points for trades. Third, it manages risks because it provides tools to set stop loss levels. And lastly, gives us market psychology insight, reflects investor sentiment and behavior, which can influence future price actions. Let's now look at four underlying assumptions of technical analysis. First, market prices reflect all available information or efficient market hypothesis. It assumes that all relevant information is already reflected in a security's price. Second, price movements follow trends. One of the key beliefs in technical analysis is that prices move in identifiable trends, whether upward, downward, or sideways. Third, history tends to repeat itself. Patterns and trends observed in the past are expected to reoccur due to consistent human behavior. Investor psychology, such as fear, greed, panic, they create repetitive patterns over time. Fourth, volume confirms trends. Increasing volume during a price trend suggests strong support for the trend, while decreasing volume may indicate a reversal or weakening trend. Finally, we are looking at key concepts in technical analysis. First, momentum. Let's imagine stocks as a bouncing ball. This is how fast the ball or the stock price is moving. If you throw the ball hard, it goes up faster, meaning the stock price rises quickly. Second, support or the floor. Imagine the ball hits the ground but doesn't go through it. The ground is like a support, it stops the price from falling too low. Third, resistance or ceiling. The ball bounces up but hits the ceiling and comes back down. The ceiling is like resistance, it stops the price from going too high. Fourth, breakout or smashing through. Sometimes the ball is strong enough to break through the ceiling. This is when the stock price goes higher than it usually does. And finally, fifth, reversal or turning around. If the ball is bouncing up and suddenly starts falling, that's a reversal when the trend changes its direction. So in this example, from uptrend to downtrend.
We'll now cover what indicators and oscillators are. It's widely believed that pure chart analysis is more subjective in nature and difficult in terms of validity testing. When it comes to indicators and oscillators, however, like those integrated here, we can arrive at buying and selling signals that are more precise and objective. Let's start with understanding the two by reflecting on this. All oscillators are indicators, but not all indicators are oscillators. Now, what does that even mean? What we're trying to say here is that oscillators are actually a subset of indicators and they are treated as supplemental tools in trend analysis. Indicators are derived from price and volume data and primarily follow trends. Their purpose is to track the progress of a trend and not to actually predict market actions. Indicators are followers and not leaders. They don't anticipate, only react after the fact. They are dynamic in nature, as they follow the trends of the market, meaning their actual values move with the trend. Oscillators, as mentioned earlier, are a subset of indicators and are meant to supplement trend measuring methods and measure momentum. They are found beneath the price chart, with the momentum line fluctuating within a range bounded by a fixed upper and lower limit and bisected by a zero line. These are key characteristics of an oscillator. Here's a summary of the use cases and limitations for both indicators and oscillators, along with the different subgroups they can be categorized in. These examples will be covered in a little bit more detail throughout this presentation. Starting with moving averages. Moving averages are the most common and widely used set of indicators. They are used to eliminate noise through smoothing. This helps to identify a trend. In technical analysis, the moving average line is compared against the actual closing prices of each period. Moving averages are simple to interpret. For example, if prices fall below the moving average line, we look for selling opportunities. If it falls above, we look for buying opportunities. A good rule of thumb is to think like a logical trader and trade in the direction of a trend. Moving averages are not that useful, however, when prices are range bound or when a clear trend is not determined. Sadly, most Philippine stocks, like that of Jollibee Food Corporation, primarily move horizontally with unclear trends. Relative to this, US stocks with clearer trends will be used as examples throughout this presentation for better appreciation of the concepts. There are two main types of moving average indicators: the simple moving average and the exponential moving average. The SMA in blue is the most used type. One criticism of the simple moving average, however, is that it gives equal weight to each period's price, meaning that recent prices are weighted exactly the same as older prices. Some analysts believe that more weight should be given to more recent prices so as to hug the trends much more accurately. This is where exponential moving averages, the orange line in the graph, come in. More weight is allocated to recent prices, making it a good option to use for shorter term trading. The exponential moving average, however, is much more prone to giving false signals. We see in this Tesla example that the EMA in orange hugs price action much more closely, but may trigger false selling signals, for example, as highlighted here, as the closing prices fall below the EMA. It's recommended, therefore, that we stick to using the simple moving average for reliability's sake, but incorporate the use of the double crossover method that combines both short and long term averages to signal buying and selling. Take this for example, where we're using the most common short and long term combination of a 5-day and a 20-day average. Here we're able to determine buying points in green and selling points in red. It's important to note, however, that moving averages are useful only when there is a trend. When there is no clear trend, we must turn to oscillators to guide our decisions. This brings us to the moving average convergence divergence indicator, which can be considered as a partial oscillator. It is a popular momentum and trend following indicator that helps to identify buying and selling signals as well. This indicator is found below the price chart and comprises the following components. We consider the MACD as a partial oscillator because it fluctuates around that base line. For reference purposes, the most common inputs for MACD are shown here as well. For referencing Jollibee as our example, the interpretation of MACD can be done as follows. Buying signal opportunity can be found here at point A, which is above the zero line. Firstly, let's take a look and zoom in at the momentum bars. In this example, we see momentum reversing from negative to positive, which is a good sign of a reversal. Secondly, both MACD and signal lines start to intersect at this point, which reinforces our buying signal. Remember, use MACD in conjunction with moving averages to be your guide. Pair its interpretation with its candlestick chart and mix in other oscillators too, like the RSI, to create a better informed decision.
Let's talk about another indicator, the Bollinger Bands. Bollinger Band is a volatility indicator that consists of three lines: the middle, upper, and lower bands. These bands adjust based on market volatility, helping measure price swings and identify overbought or oversold levels. In short, Bollinger Bands lets us see whether prices are moving too far from the average. To fully understand how Bollinger Bands work, we must understand the concept of volatility. Volatility is a key concept in trading, representing the rate at which prices change over time. High volatility indicates significant price swings, often associated with strong trends or major news events. Low volatility reflects smaller, more stable price movements, typically during periods of market consolidation. Now that we've defined volatility, let's see how it translates into the structure of Bollinger Bands. Let's look at the stock of Ayala Land Incorporated. Here's how Bollinger Bands are structured. The middle band is a 20-period simple moving average. The upper band is the middle band plus two standard deviations, while the lower band is the middle band minus two standard deviations. When the bands widen, it reflects high volatility and rapid price movements. Conversely, when the bands narrow, it indicates low volatility and market stability. With this structure in mind, let's discuss how traders use Bollinger Bands to identify market opportunities. Bollinger Bands help traders interpret price movement. When the price touches the upper band, it may indicate overbought conditions, signaling a potential reversal or consolidation. Similarly, touching the lower band may indicate oversold conditions, suggesting a potential upward bounce. One key signal to watch for is the Bollinger Band squeeze. This happens when the bands narrow, signaling low volatility and the potential for breakout. If the price breaks above the upper band, it signals a bullish breakout. However, if the price breaks below the lower band, it signals a bearish breakout. Traders use these patterns to anticipate significant price movements. While Bollinger Bands focus on price volatility, another critical aspect to analyze in trading is volume. This brings us to on balance volume or OBV. On balance volume or OBV is a momentum indicator that predicts price changes using volume flow. The main idea behind OBV is that volume precedes price, meaning changes in volume often happen before changes in price. OVB measures the buying and selling pressure in the market. Rising OVB indicates accumulation or more buying pressure, which is bullish. Falling OBV signals distribution or more selling pressure, which is bearish. OBV is valuable tool for confirming trend and predicting potential reversals. Let's see how OBV helps confirm trends in trading. OBV is great for confirming price trends. When OBV is rising and the price is also moving up, it confirms the uptrend is supported by strong buying volume. Conversely, when OBV is falling and the price is also declining, it confirms the downtrend is supported by strong selling pressure. This combination ensures that the price movement is backed by solid volume, making the trend more reliable. OBV is also useful for spotting divergences, which can signal trend reversals. Divergences occur when the price and the indicator move in opposite directions. A bullish OBV divergence occurs when the price makes lower lows but OBV indicator makes higher lows. This signals that buying pressure is increasing even as the price falls, indicating a potential reversal to the upside. On the other hand, a bearish OBV divergence occurs when the price makes higher highs but OBV indicator makes lower highs. This signals that selling pressure is increasing even as the price rises, suggesting a potential reversal to the downside. These divergences provide early clues about shifts in market momentum, helping traders anticipate price reversals.
Okay, so for my part, I'll be focusing on two of the most common oscillators, the Relative Strength Index or RSI and the Stochastic Oscillator. These tools tell us if a stock is moving too fast or too slow and help us decide the right time to buy or sell. So first, we go with the Relative Strength Index. So RSI measures how fast the price of a stock is moving. It gives a score from 0 to 100. If the score goes above 70, the stock is overbought, meaning people are buying too much of it and the price might go down soon. Now, if the score goes below 30, the stock is oversold, meaning people are selling too much and the price might go up soon. Now, for example, let's look at SM Investments. A recent chart shows that its RSI spiked to 74.81. Soon after, the price of SM started to drop. This would have been a signal to sell before the price fell further. As we can see, the price dropped from 921 pesos to 882 pesos. That's a 4.21% drop on your investment in SM. Another example is a situation wherein the RSI is below 30. Here on the slide, we see SM's RSI score barely below 30. This was the signal that the stock would rise afterwards, and true enough, the stock price did rise. From just 882 pesos, it went up to 900 pesos, equivalent to a 2% increase. Now, for the second one, we have the stochastic oscillator. The stochastic oscillator checks how the stock's price today compares to its price range over a specific time. It uses two lines: the K line, which is the main line showing momentum, and the D line, the smoother moving average of K. Now, when the K crosses above D, or when K is greater than D, it means the stock might go up, and this is a potential buy signal. When K crosses below D, or when K is less than D, it's a sign that the stock might go down. It's also a potential sell signal. Now, when you use the stochastic oscillator, you might be wondering which type of stochastic oscillator you will be using, because there are actually two options. There's the fast or the slow. So for the fast stochastic, this is favorable for those engaged in day trading and if the stocks eyed are considered as highly volatile. On the other hand, the slow stochastic is used when the trader strategy is focused on swing trading. This is also useful for evaluating stable stocks. Now let's look at Ayala Land Inc. or ALI or ALI. So on a recent chart, the K line crossed above the D line. So the K is greater than D, as you can see on the picture, signaling a buy potential. Now, true enough, the price does rise by 1.50% from 29.9 pesos to 30.35. Another example is when the D is greater than K, which is a signal to sell. As observed from the chart and trend, the price did drop further to 29.2 from 29.6. This is a downside of 1.35%. Now, the RSI and stochastic oscillator are simple yet powerful tools to identify the right time to trade stocks. While, while the RSI measures the speed of price movements, the stochastic oscillator compares the current price to its recent range. Always remember to combine these tools with other indicators for more accurate predictions.
Let's now look at some technical indicators, their purpose, and what they do. First, if you want to identify the direction of a market, whether up, down, or sideways, use moving averages and MACD. It smooths out price data to show the overall trend. Second, if you want to show the strength or weakness of a price trend, use RSI and stochastic. It tells if a stock is overbought or too high, or oversold or too low. Third, if you want to show how many stocks are being traded, use volume bars and OBV. It smooths out price data to show the overall trend. Lastly, if you want to show how much the price moves up and down, use Bollinger Bands and ATR. It shows you how bouncy or stable a market is. And that ends Team Bini's report for indicators and oscillators. Happy trading and thanks for watching!